Well, good afternoon, and thank you for joining us for another edition of Origin's Advisor Series. My name is Michael O'Shea, and I'll be moderating our panel today. Today we're going to be talking about from tax burden to tax advantages and smarter wealth strategies. So if you've joined us before on the Origin Advisor Series, the purpose of this series is to bring you value-added content, and then we want to bring in experts that are utilizing these strategies on a day-to-day basis. So today we've got Glenn Shirley, Head of Investor Relations at Quantinno Capital Management, and Cliff Hodge, the Chief Investment Officer of Cornerstone Wealth Group. And so we appreciate them being with us. I'll introduce them in just a moment. A little bit of background on Origin Investments. If you are not familiar with our firm, Origin is a boutique real estate asset management firm based here in Chicago. We run about $4 billion in assets, and we focus exclusively on the multifamily market. This is a topic that is near and dear to our hearts, as Origin was really built for the taxable investor. And so all of the products we focus on, whether it's our equity fund through depreciation, whether it's our qualified opportunity zone fund for capital gains taxes, or whether it's our 1031 exchange solution for clients that have appreciated real estate, our solutions are really for the taxable investor that wants to keep more of their money in their pocket and pay less taxes. So we do this on a quarterly basis. We really appreciate you taking the time out to join us today. And I'll talk a little bit about why we think tax advantage solutions are so top of mind. You've got a couple things that are happening right now. Obviously, everybody sees what's happening with the markets. And so a lot of customers out there have a very appreciated position in the stock market, and we're starting to see interest rates come back down. And what that's leading to is higher and higher valuations for private businesses. So this is a good thing and a bad thing. We're seeing the value of assets increase, but what that does is it causes a problem for these high net worth and ultra high net worth clients that want to avoid taxes. So it really creates a solution to come in and solve the problem. Worked with high net worth families and offices for many, many years. And one of the things that I've noticed is that they're very, very good at making money. And so to hear about the next seeking alpha or how you can get a higher rate of return is not always as interesting to them. What they're focused on is how can I pay less taxes and how can I simplify my life? And that's a great way to earn referrals and new business and new assets under management. So that's why we're going to be talking about it today, but we want to really bring it to life. We don't want to just talk about solutions at the 30,000 foot level. We're going to be talking about how we implement this into client portfolios and solutions that we've seen that have actually worked for clients using case studies, etc. So before we get going, I do just want to sort of introduce our esteemed panel that we have joining us today. So Cliff Hodge is the Chief Investment Officer at Cornerstone. Cliff oversees all aspects of investment due diligence for the firm with a focus on asset allocation, research, security analysis, manager due diligence, and portfolio construction. So Cliff chairs the firm's investment committee and partners with committee members overseeing the overall investment strategy. Cliff earned his undergraduate degree in economics from Clemson and a master's from the University of South Carolina. He also enriched his investment management expertise by obtaining the Chartered Financial Analyst designation and through executive education programs at Harvard Business School. His dedication to fostering global leadership is evident through his participation as vice president of the South Carolina CFA Society and through his contribution to the board of Capital Group's National RIA Advisory Board. And just on a personal note, he and his wife, Lindsay, take pride in raising 3 outstanding children, Finn, Jack, and Addie Rose. In his spare time, Cliff enjoys spending time with the family and his dogs, watching football, mountain biking, and traveling. Thanks, Cliff, for being here today. And just quickly on Glenn. Glenn is a partner at Quantinno. He serves as head of investor relations. And since joining the firm in 2019, Glenn has actually led the business development and client service effort at the firm and grown from 70 million in assets to over 31 billion. His expertise has ranged from providing financial advice to clients firsthand to business development roles across numerous client segments in asset management. Glenn started his career in Merrill Lynch Global Private Client Group and was a research analyst at a large RIA firm. He served as a member of the business development team at a large institutional hedge fund, and Glenn earned an MBA from the University of Notre Dame and a BS from Butler University. So go Irish. And
go Irish.
Thanks for being here. So I went to Purdue, so we had Butler, Notre Dame, and Purdue all on the same call. Well, guys, thank you for joining us. As I think everybody can tell from those resumes, very, very esteemed panel, very, very knowledgeable on what we're talking about today. And so looking forward to bringing this to life. Before we get started, I would just have a quick disclosure here. Everything in this presentation is for informational purposes only. This is not an offer to buy or sell any securities. And this is just for informational purposes only. So I think before we really dig into the actual strategies, we want to talk about the impact that taxes have on wealth. And maybe people don't think about it, right? It's like, well, I've got to pay taxes no matter what, so I'm just concerned about what my return is. But when we really think about, it's not necessarily about what you make, it's about what you keep. Let's just talk about how this can impact wealth. And I guess I'll start out with Cliff. What do you think clients are most surprised to learn about when they see the impact of taxes, modeled into their portfolios at Cornerstone?
Yeah, thanks, Mike. Pleasure to be here, and appreciate the opportunity to chat a little bit about something that is near and dear to my heart, and problems that we see and face all the time at Cornerstone. And we're an RIA based out of Charlotte, North Carolina. We work with high net worth individuals, families, really across the spectrum. And we see this quite a bit, especially when we are just beginning a new relationship with a client or onboarding a client. A lot of times they are shocked at just how much taxes can eat into their returns. I love what you said. It's not about what you make, it's about what you keep. That should be the focus of every taxable investor. What do I take home at the end of the day after fees and after taxes? So an interesting story, we just had an opportunity with a new client that we onboarded. He was a do-it-yourselfer, right? Hey, Cliff, why do I don't need an advisor. My portfolio did fine last year. 15%, I made $750,000. Tell me why I need you. Great question. And as one of the services or the value adds that we try and provide, especially with working with new clients, is we want to understand, not only their portfolio construction, their needs, objectives, but also run a tax analysis. And so we ran the math and said, hey, yes, you were right. You had a very nice return pre-tax last year, but of that $750,000, you owe almost $200,000 in taxes. And they had a mixture of hedge funds and just private credit, some tax inefficient vehicles, and there was not a whole lot of thought put into asset location or where these assets are held. And so the story became one of, defending why this person needed to work with an advisor to, hey, let me show you how much actual money we can save you, where we can, compete with the returns that you're getting, not drastically alter your risk profile, but just by being smarter about portfolio construction and introducing some tax efficient strategies, the money that we're going to save you is more than going to offset our fee and provide you a much better experience from a tax perspective, where at the end of the day you do get to keep more of what you earn. And it was really eye-opening, right? And a lot of times clients understand they have to pay taxes, but until you show them an actual hard dollar amount and then relate that back to what their portfolio is returned so that they can compare apples to apples right next to each other, they intuitively get it, but seeing those hard dollar figures is really eye-opening.
Yeah, and I think too, would you say it's fair to say that this might be a blind spot for clients where they're just not thinking of whether this income is taxable or not and what sort of account it's in, and you have a solution at Cornerstone that maybe helps you identify it?
Absolutely. It's a blind spot for clients, and sometimes it can even be a blind spot for advisors. And I think the industry has done a much better job recently in being more thoughtful about things like portfolio construction, asset location, understanding which types of investment opportunities, especially now with this proliferation of private market vehicles that are available to the private wealth channel. There's just a lot more that we can do as advisors, not only to shine the spotlight on the problem, but then also educate and offer solutions for clients to really justify the value add that we should be bringing to the table.
Yeah, well, that's fantastic, and thank you for that. And maybe just bring in Glenn here, I suppose. Glenn, thanks for being here. I guess same topic. Talking about taxes and maybe investors and their blind spots. When people are coming to you and they're coming to Quantinno, what do you see as the biggest tax inefficiency to kind of how clients are currently allocated?
Sure, great question. Before I get going, thanks to Mike, the Origin team, Maria, and everyone for having us. Thrilled to be with you. So at Quantinno, our business is helping clients solve their challenges in portfolio, specifically taxable clients. The background of the firm is investment research. So investing in great companies you think are going to go up, shorting companies you think are not so strong and are going to go down. Getting that right adds a nice investment return. That's key to everything we do at Quantinno. But the specialty, the focus of the firm is being trained as a CPA, thinking about tax. And using long-short strategies means you're in a position to generate very strong and consistent tax benefits for clients. And that means we're in a position to help clients who pay capital gains tax. They may potentially be able to pay less. We're also in a great position to help clients make changes in their portfolio, which I promise I'm going to get to your question here, Mike. So I don't see necessarily inefficiencies in portfolios as the challenge. It's that as you get more creative in your portfolio, you tend to take a step away from tax efficiency. So the most tax efficient strategy would just be buying a stock and holding it forever. But that's not a great investment strategy. You could buy an ETF that's more diversified and hold that forever. But you may want to invest in fixed income. You may want to invest in alternatives. So the buy and hold, very tax efficient strategy may not be the best portfolio strategy. So as you get more creative, maybe you add some direct investments, you add some alternative investments, you add fixed income. Well, these are all introducing some tax inefficiencies. They may come with short-term capital gains, long-term capital gains. They may come with ordinary income, which means as you're earning, you're appreciating, a portion of that growth could come to be taxable, which means you're taking a couple steps forward, but one step back as you pay tax. So, in Cliff's shoes, the more creative he tends to be, the more thoughtful he has to be with tax efficiency. That's just a part of the portfolio management process. So at Quantinno, what we try to do is just help clients use their equity allocations more efficiently, generate great tax benefits from that equity allocation. Those tax benefits can be valuable and help offsetting the tax liabilities that come from a creative asset allocation. That means clients are compounding at higher values. Their wealth is building through time at a more enhanced fashion, because they're not taking a step back each year to pay tax on the growth of their portfolio. So that's just one of the many challenges we've helped clients solve via our unique implementation at Quantinno.
Well, that makes sense, and I think that's one of our thesis, is to sort of stay invested for the very long term without the frictional costs of not only taxes but also fees. And so it's very important. It helps clients grow wealth, and it is a blind spot. So let's maybe talk about some of the actual strategies that we're putting in practice. And so, Cliff, kind of going back to you and what you guys are doing at Cornerstone, some of these strategies are complex. Some of them are actually quite simple. Which strategies, are clients, are you talking to clients about that they say, okay, I get this right away? And which strategies are requiring a little bit more education?
Yeah, it's a good question, Mike. And a lot of the times it's going to depend on the client's background, their level of sophistication, but so it varies. I think in general, most people are well aware of things like manual tax loss harvesting. You own a long-only portfolio. At some point during the year, either if you have a loss in a name, or maybe you wait and do it all at year end, you sell your losers, take the loss, and then reallocate that into another another like security, or perhaps even something a little bit different. That was kind of the old school model of tax loss harvesting, but people intuitively understand that. In a lot of cases, they also will understand long-only direct indexing. That's kind of tax loss harvesting 2.0, where it's a very similar concept. Maybe it is a passive strategy where you're tracking an index, or maybe it's actively managed, but it's done with more higher frequency, right? A lot of time there are technology tools that get introduced to help make that process more streamlined, take that lift off of the advisor's plate. Real estate is another area where people are pretty comfortable understanding the depreciation offset that you can get, income generated in the form of return of capital for a period of time, understanding why that might be valuable for after-tax wealth allocations. But when you really get beyond those, it starts becoming more of a educational requirement, right? From our perspective as the advisor and helping the client, we have to know our stuff, and then we have to be able to explain it to clients in a way that they can understand. Maybe one other one I'll throw in, asset location, I think is very intuitively straightforward and somewhat easy to implement. But for whatever reason, I don't think that many people take advantage of that factor. And effectively, what you're doing there is it's all about where you own certain assets. So you want to own tax inefficient assets, things that generate ordinary income, corporate bonds being a great example, private credit being another. You want to make sure that you are filling up your qualified buckets in your portfolio with assets that are tax inefficient, and then consequently use your after-tax accounts and allocate to the assets that are more tax efficient. So typically equities, ETFs, as Glenn outlined. So those are some of the easy ones, some of the low-hanging fruit, if you will, table stakes. I think when you start introducing more advanced strategies, that's really where we can add a lot of value. Quantinno is very active in this space. Long-short direct indexing is a really interesting strategy, and Glenn can go into the nuances there. But effectively, it is that tax loss harvesting 3.0, if you will, right? Where it takes that traditional simple concept of selling losers, taking the tax loss, and then reinvesting it. It's a much more efficient mousetrap with the way that these portfolios are structured, and there are a ton of use cases. And we can talk a little bit more about some of the use cases, but maybe I'll pause here and let Glenn talk a little bit more about the mechanics, if that makes sense.
Yeah, that's pretty good. And for people on the call, if you don't know, qualified accounts really just referring to tax advantaged IRAs, 401ks, et cetera. And I think what I heard Cliff say is that if we have fully taxable income like corporate bonds or private credit, maybe those make sense in those tax advantaged accounts, whereas other investments like real estate through depreciation is tax advantaged in and of itself. So you could put that into fully taxable accounts, municipal bonds, and some others out there that can be tax efficiency is just part of the vehicle itself. And Glenn, I think we're excited. I haven't heard of this 3.0 yet, so I'm excited to hear that. But let's talk about kind of portfolio level tools and maybe what are the most effective tools that managers can use to reduce the tax drag.
Absolutely. Well, I think long short tax loss harvesting would be one of those great tools. So think of doing tax loss harvesting, as Cliff mentioned, starts with owning equities. So think of if you buy hundreds of equities, early in that portfolio's life, there's going to be cross-sectional volatility. There's going to be winners and losers across a couple hundred equity names. So the ones that are down, they're sold. That's a great tax loss that helps offset capital gains. The ones that are up, you tend to not touch those. That's tax efficient growth. So that's worked really well. There are advisors that do that for clients in December, kind of a la carte. There are professional firms that have done that for decades. We should all be grateful to those firms. But they all have the same kind of structural issue. It's that generating great tax benefits is always conflicting with the growth of that equity portfolio. So as your equity portfolio is growing, you just have less and less names in that account that are at unrealized losses. If every stock in your account is appreciated, we have no further ability to generate tax losses. That growth period is when clients need these tax benefits to help offset capital gains. So it's kind of a large problem for the industry. Quantinno's been a pioneer in solving that. So now think of your training as a firm as investment research. So if you go long and short names, you're thoughtful about how to do that. If you're good at that, then you can introduce an investment return of that implementation. But now think of you're a couple hundred stocks long, but also a couple hundred stocks short. So now you've gone beyond just owning stocks. Now you also have a short component as well. And now think of the markets just keep going up for the next 10 years. Well, you now have short positions. As markets rise, you're going to have names in that short book that have lost value. As shorts rise, they're losing money, not making money. So if you have a short component to the strategy, that means as markets rise, you're always going to be able to generate valuable tax benefits for clients. But assuming you have public assets in your account, you have stocks, you have bonds. If all we did was just short stocks, then what have we done? We've drugged down the portfolio's exposure to markets. So clients want to be invested in stocks. They want to be invested over the long term. So a long and short component is market neutral. So if you own long and short stocks, you've introduced this engine of generating great tax benefits for clients, and we haven't added any market exposure to that. So clients can use existing equities. That's what is in their account. That funds the long and short. So there is a cost to that, but we aren't asking clients for any new cash to establish that long and short position. That's now the engine to generate great tax benefits for clients. So this is 3.0 because it's not easy to do. You need to be thoughtful about how you take the long short positions. You need to manage risk well. But a successful long short implementation of tax loss harvesting means you have an engine to generate great tax benefits for clients over the long term. And it's kind of regardless of market direction. So now with that implementation, what can we do? Well, if clients have capital gains naturally from their portfolio, the capital losses that we generate can help offset those gains. That's a more efficient, tax-efficient compounding of their portfolio's growth. If you want to make changes in your portfolio, those changes are typically going to revolve around selling assets that are appreciated to buy something else. Selling assets that are appreciated will realize capital gains, most likely. But if we have these capital losses from that long-short implementation, those losses will offset those gains, leading to a more tax-efficient portfolio change. So now you don't have to essentially realize gains to have a better risk-return profile of your account. You can make changes knowing that these valuable tax benefits are there to offset those.
And the way I understand it is you're going to have exposure to these equities anyway, whether it be the S&P 500 or some other index. And so this is just a way of keeping that same exposure and keeping that same risk reward profile but capturing losses along the way. Is that fair?
That's right. Yeah. If clients have been invested in equities, they stay invested in equities. Now they just have a long short component on top of their equity portfolio. And we aren't asking any clients to realize gains in those portfolios to make the transition. Now, we make it really easy to work with us. Keep your very appreciated portfolio, put on the long and short. Now you have that engine to generate great tax benefits going forward.
And do you see advisors making mistakes? Like, one of the things I think about is like, oh man, I wish you would have called me before you did X or Y. Like, do you see a pretty common mistake that maybe we can avoid?
Yeah, I think an advisor can be really helpful to a client if they sell a major asset, if they sell a business. Mm-hmm. But I think the way entrepreneurs work is that they work really hard, they build a business, they sell the business, and then they say, oh, I need Cliff and the Cornerstone team, I better give him a call. But if you sold your business in October or November, that means you realize that gain in tax year October 2025, which means if you're trying to generate tax benefits to offset that tax liability, now we only have 2.5 months to do that. Yeah. So I would say what clients should be thoughtful about is if there is a large capital gain event or another tax liability on the horizon, talk to your advisor as soon as possible, because that's a great planning exercise. With a great team beside you, you can plan for that future tax liability, use these type of strategies like long, short tax loss harvesting, start generating these tax benefits, which can carry forward into future years and help offset the major capital gain or sell of a business. So, sorry, go ahead.
Yeah, I think that's a really good segue into what we're talking about, because most of these solutions, whether they're simple or complex, all of it is about discovery with a client and understanding their risks and needs and tolerances, and then setting goals for the future. So we don't want to be looking back and saying, oh, I sold that real estate. Well, did you put the money with a qualified intermediary? Oh, no, well, then you can't do a 1031 exchange. Or how long ago did you sell that? Oh, 8 months ago. Well, now you can't do an opportunity zone. So it's really about, I think, getting in front of it. I think you would both agree. And so, Cliff, I guess maybe just thinking about the Cornerstone team and how you work with clients and do your financial planning, what's the advisor's role in kind of helping clients prepare for these liquidity events that maybe they haven't thought about yet?
Yeah, Mike, Glenn, I think you guys hit on it. The biggest part or opportunity for us as advisors is to really be proactive in deep discovery, asking questions, trying to prompt our clients to think outside of the box, whether that just be the next 12 months, but really taking a more thoughtful and long-term approach. And I would argue that it is our responsibility to uncover these unmet needs and objectives before they happen, right? I think the biggest mistake that an advisor can make is not knowing that their client is going to be selling a business or has a commercial property that they're liquidating. And we really do our clients a disservice if we are not thoughtful about really getting that information on the front end. But then armed with the information and knowing, what the particular opportunity set is at hand, then our role changes from discovery to then education or enlightenment, right? Having an understanding of what are the available options in the marketplace or solutions in the marketplace to meet a specific need. Being able to walk our clients through the pros and the cons and all of the decision-making criteria. And then ultimately helping advise clients or helping clients make that choice, right? And so I view the advisor's role really as a guide. In some cases, depending on the client situation, the needs are going to be a little bit more intensive or less intensive. The decision making is going to be more reliant on us as the advisors, but the education component is key. And then keeping clients abreast of how things are going, right? If we, I'll give you an example. We have a client, we work with a lot of entrepreneurs at Cornerstone, a lot of business owners. And the decision to sell your business is a very emotional and personal one. right? Once you have spent your entire life building out this business, a lot of business owners, their identity is completely wrapped up in their business. And so, not only is there a major life event, but there's also this major tax event looming, right? And so we have a client that came to us earlier in the year and said, all right, guys, I think I've got another 3 years before I go out and sell the business before I retire. And we were so thankful for the client for giving us this information, because in these types of scenarios, time is on your side, right? Especially if you have a significant amount of pre-tax assets that can be put to work for you in strategies like what Glenn mentioned with long-short direct indexing. There are also some hedge fund solutions out there as well that you can incorporate for qualified purchasers that meet the SEC accreditation requirements, where not only are clients still able to participate in the market and get the returns and the upside of the market, but also generate some pretty significant capital losses that can be carried forward. You roll that over 3, 5, 7 years, then the dollar amounts are significant, and not all cases are you going to be able to completely offset the gain of selling something like a small or medium-sized business, but it can go a long way toward taking a big bite out of that tax bill when the client finally does sell. Even though they say it might be 3 years or might be 2 years, with business owners, we find that it's always a year, 2 or 3 after what they tell you. So getting on it early, I think, is the best thing that we as advisors can do for our clients.
Well, and you never know if people get unsolicited offers or offers you can't refuse. I think as you're preparing to sell your business, it's really important to get your accounting lined up. You want to get that EBITDA dialed in so that you could sell your business for as high as you possibly can. And if you're prepared for that, then you're prepared for any offers that come along the way. And the higher you sell it, the higher taxes you'll have, and the more that these solutions can be beneficial for you. One thing I would just kind of mention here too is just kind of the unique strategies that we have here at Origin is the Opportunity Zone Fund, which you may have just seen has been updated with the new tax legislation. It's become a permanent part of the tax code, and I believe you're going to see a lot more about Opportunity Zone funds going forward, but also the 1031 exchange. This is something that you really have to get in front of, and I do get calls where people say, hey, the cash is in my bank account, I'm ready to do a 1031 exchange with you. Well, you have to put the money with a qualified intermediary first. And so if you've taken the possession of the proceeds, you actually can't do a 1031 exchange anymore. Now, there's other things that we can do, but it's very, very important to stay in constant communication. As far as finding these deals, I think it's really just an important part of discovery. Maybe clients don't think that real estate or assets outside of stocks and bonds are part of the discussion. But if you build it into the discovery and ask, do you have Schedule E income? Oh, you have rental properties. Great. Do you enjoy managing those? No, I actually can't stand managing them, but they've been a good investment. Okay, well, a 1031 exchange solution can maybe solve that problem for you. So it's really important to get out in front of it, ask questions, and understand the client situation. And one thing I was thinking about too, Glenn, was kind of the way that your long-short strategy and tax loss harvesting works. It's a really good partner with qualified opportunity zones. And we're not going to go into all the details of qualified opportunity zones, but essentially the way the platform works is it applies to any capital gain from any capital asset. You don't eliminate that gain. What you do is you defer it. You defer it out into the future, and you create this deferred tax liability. For example, if you had $1 million sale and a $300,000 tax liability, you wouldn't have to pay that today. You'd have to pay it down the road. So if you know that you have this future deferred tax liability coming, you could invest in some sort of Quantinno portfolio that's going to give you the same exposure to the equity markets that you already have. It's going to build up a pool of capital losses, which you could then use to offset that deferred tax liability. And the entire investment could be potentially tax-free to the investor. So that sounds like a pretty powerful combination, Glenn. I don't know if you agree.
I do, yeah. And I just want to be clear too, in these accounts, long, short tax loss harvesting with Quantinno, if I go long hundreds of stocks, short hundreds of stocks, we're going to be able to generate capital losses, but think you're going to have stocks in that portfolio that are at appreciated levels. So there's also going to be some embedded gains in these accounts. So if a client just totally wanted to sell out at some point, they would have a capital gains bill. So there's not elimination of tax necessarily in what we do either, but there also is the ability to defer those gains as long as the investor so chooses. They can also be donated to charity.
Yep.
You could be pretty thoughtful about what that unwind looks like, because this is the client's managed account at the end of the day. With that comes a large amount of flexibility, optionality, transparency, all good things for investors.
And Mike, if I may, you bring up a great point where a lot of times for a specific client situation, there is not just a single tool or a one-size-fits-all approach. In a lot of cases, really the power is in the combination of a number of these tax-efficient strategies put together on behalf of a client is going to be just so much more powerful than treating every situation as a nail, right? And having your one hammer. You really want to take the time to educate yourselves as advisors, and then understand what all the tools in the effective toolkit are, and then how you can use them in tandem on behalf of clients. That's really where the power and the solutions are optimized.
Yep, I agree with that 100%. And I think just to kind of wrap that up, Cliff, just thinking about maybe where we're missing opportunities here to address future tax liabilities early, what are you seeing there?
Yeah, I mean, I think we've hit on a good bit of that already. I mean, not asking the right questions, not having an understanding, not being the quarterback for your client if they are going and doing things on their own without talking with you first. You mentioned the 1031 opportunities, or perhaps even the QOZs, qualified opportunity zones. There are regulatory requirements. There are time elements involved, and so our job as advisors is to make sure that we are top of mind for our clients, that we have hopefully already had discussions around what some of these major life events or life changes are and look like, so that hopefully they're coming to us early on in the process before they do something that cannot be undone, which is detrimental. And you know what, hey, it happens. But time is a very important factor in any and all of these strategies. And the more time you have to get them implemented and be in front of it, the better off everyone's going to be.
Great. Well, that's a good answer. And I think, let's talk a little bit about implementation. And maybe before we do, just a quick reminder, we do have a Q&A box. We will be taking a little bit of Q&A at the end here. So if you have any questions, go ahead and type them in there. And we will get to as many of those as we can at the end of the presentation. So thinking about sort of action steps and everything we've learned that, taxes erode wealth, there's solutions out there. You have to get in front of them. You have to be talking to clients. You have to find this sort of blind spot. So okay, how do we get there? I guess going right back to you, Cliff, how do you suggest advisors evaluate these products and the implementation process, maybe without overcomplicating the client's portfolio?
Yeah, the overcomplicating piece is important. There are so many new solutions coming to market, so many providers, so many ways to access them. I think for everyone who's participating on the webinar today, they're making a great first step, right, with educating themselves about who some of the providers are, what types of solutions are out there. I will say for a number of advisors, especially if you don't have a full-time dedicated investment team, working with some of these platforms that have come to market over the last couple of years, I think is a pretty interesting way to start understanding the ecosystem. There are technology platforms out there, groups like Case, groups like iCapital, and several others that do a nice job of amalgamating a number of different alternative types of strategies or tax efficient strategies where they house all of the materials. You can get on the phone and they can connect you with someone at the team. Oftentimes there's third-party due diligence that's available as well. So that's one way to do it. I think another interesting way to do it is really just knowing your clients, knowing your book, and what are the challenges that repeatedly are surfacing, whether that be selling a business or real estate, so on and so forth. Focusing on one problem at a time, with especially problems that continue to pop up, I think is a good way to get started. There's no shortage of information or resources out there. A lot of times you just have to reach out and ask.
Yeah, I think that makes a lot of sense, and we do have some advisors on the call. We have some individual clients on the call, and I think kind of a question for advisors, but any of the individual investors out there, if you do have appreciated real estate, if you've got appreciated stock positions or restricted stock units or a potential large tax liability, all of our information will be here on the last slide. And if anything Cliff has said in this conversation could be helpful to you, reach out to him and his team, and they will do a discovery for you and see if they can save you some taxes and make your life a little bit simpler. But thinking about the advisors that may be listening of how to implement this, Cliff, a lot of this stuff maybe is just out there. Like, what could we do like in the next 30 days, the next 60 days? How do we start implementing this in our practice?
I have a thought here, which is a little bit outside of the box, but I've been spending a lot more time personally with ChatGPT and AI, some of the large language models. And it's, while we don't rely on any of the output in our business, as a brainstorming exercise, I think there's some pretty interesting feedback and output that you get from some of these. So one thing I've done recently is just to kind of test it and see what it would say was, made up a client scenario where, a client was going to be offloading a commercial property in the next 2 years. These are some of the considerations. This is some of the backstory of the client. You, ChatGPT, are their advisor. What should we do? And it was actually pretty good. The feedback. I mean, it talked about 1031s. It talked about QOZs. So that's just one thing that you can do. And then what's also interesting is that it'll cite websites. Origin will show up if you prompt it the right way, right? And so you can almost use that as a brainstorming exercise. It can provide information on real life situations. It can point you to educational materials. It can point you to sponsors and providers for some of these solutions. So that is my outside the box answer on what participants can do in the next 30 days to get smarter on tax efficient investing.
Well, we're all gonna keep doing it. It's just growing like crazy. I know that I use AI to sort of figure things out for me, and it's all coming more and more to the surface, and that's why holistic financial planning is going to become more and more important. And I call that sort of the non-financial part of financial planning, and we all need to get a little bit smarter about it. So I think this is really interesting. We are going to get into some Q&A, I guess. Really just a couple last thoughts. I was interested just listening to you all talk that this is, my takeaway from this is that this is sort of top of mind for investors. It does tend to be a blind spot. People know that I potentially have a large tax liability with these assets that I own, or these restricted stock units, or this appreciated real estate. I'm not quite sure how to fix it. And so it's like a gnawing problem. I mean, I just want to be able to address it. And maybe I'm just unaware of some of the solutions that are out there. They sound overly complex on the surface. But when you have a team that really does things like this every single day, yeah, maybe it's complex behind the scenes, but it can be implemented pretty simply into portfolios. and that's a very efficient way of running it. So curious, maybe just go back to you, Glenn, a little bit. Just, kind of what are your takeaways from what's going on in the marketplace, the future of these, tax alpha type of solutions, and what investors can do today?
Yeah, it's a great question. And, to avoid speculating, I'd just say that the investment world's only going to get more sophisticated. With that sophistication comes more tax inefficient strategies. They'll add to risk and return. They'll make your portfolio more valuable. But I would say the need to be focused on tax efficiency is only going to increase in future years. I would also say, if we polled the audience, most would say our tax rates are not going to go down over the foreseeable future. If anything, they may creep up. I'm not going to speculate on that. But again, if tax efficiency is important, then the tax benefits we're generating are much more valuable to clients if they have higher tax rates. So I think it's only going to be more important in the future. It's only going to be more valuable in the future for those reasons. So, our job at Quantinno is to help with tax loss harvesting portfolios. Clients have appreciated, their equity portfolios have appreciated. It's a really good problem to have. It's our job to make sure those portfolios have a nice tax efficient outcome going forward, or a tax positive outcome. Clients can have great portfolios. They could just hire Quantinno to put on a long short portfolio. Our goal there would be to make a small amount of investment return while generating great tax benefits. That gives great advisors a lot of optionality going forward. And a big business of ours as well is concentration. A lot of clients are going to build wealth via a couple great stocks. Maybe it's selling a business. Maybe a business goes public and results in a large amount of one single stock being held by a family. Quantinno's pretty uniquely positioned alongside other great tax strategies to help in that use case. So my speculation is what we do is valuable today, but it's only going to be more valuable in the future.
Yeah, totally agree. And I guess, Cliff, maybe just a closing thought, and we'll take some questions.
Yeah, it's interesting. We talk a lot about tax alpha versus investment alpha. And in the public markets, with just so much competition and the way things that have been evolving, especially within the S&P 500, for example, which is now a portfolio concentrated. I think the most recent number is 41% of the market cap of the S&P 500 is in 10 stocks, 10 technology AI related stocks. And so as an active manager, investment alpha is just getting harder and harder. There have been no shortage of news stories about hedge funds recently that have been going out of business because that investment alpha is getting competed away. Tax alpha, on the other hand, I think is underutilized and can be an afterthought. But if you compare a portfolio that has not done that, you can take a look at and has not put a whole lot of thought into tax efficiency and the amount of real alpha in real percentage, real dollar figures that can be earned or kept just based on thoughtful portfolio construction, based on being smart about the types of solutions that you're implementing, where you're holding these assets. The tax alpha that you can generate from that exercise will blow the investment alpha that you can generate out of the water. And to your point, it doesn't seem like tax rates are going down. We've got so many budget deficit problems. We've got to continue to raise money in order to pay for all of the spending. Well, how do you do that? Well, higher tax rates are an easy answer. So it's only going to be more important. It's a way for us as advisors to really differentiate ourselves and provide that wow experience for clients, which is harder and harder to do being an active manager just in public markets.
Absolutely. No, that's a good way to finish up, and I appreciate both of your thoughts. We do have a lot of questions that are coming in, and maybe I'll kind of dole these out. So everybody that's still kind of on the call, if you have other questions, we do see these live, so you can add your question, and if we have time, we will get to everything If we don't answer your question, all of our emails are here. You can feel free to reach out to any of us directly, based on whom you think could answer it best. But, a couple of these, just a really simple one, Glenn, sometimes we got to go back a little bit and forget maybe who's on the call. We use a lot of vernacular in our business, like shorting stocks. Can you explain what it means to hold short positions in equities?
Of course, yeah. So if you go long a stock, then you buy a stock, say at $10, you want that stock to go up. So it's going to appreciate in price over time. So if I want to short a stock, what I want to do is profit from that stock going down. So functionally, what I'm doing is I'm borrowing that stock from Fidelity. They loan me that stock that's worth $10. I sell that stock short, which is essentially selling the stock. If it goes down, then I can buy that stock back at a lower price, but I profited because what I bought it back for is less of a value than what I borrowed it at. So say if a stock I borrow at 10 and sell goes down to 9, well, I can buy it back at 9. I made that dollar of appreciation. So shorts can be valuable in portfolios because then if markets go up, you can have appreciation. But if markets go down, now you can have a way to make a positive return in an account. So most alternative strategies that are introducing a return that's not dependent on the equity market to be successful, typically they're both long and short portfolio holdings of some sort. It's also valuable from a tax perspective. Sorry, let me finish with this, Mike. If you can have short positions and markets go up, then you're going to have a short position that has a loss. You can generate a great tax benefit for clients. That's valuable because it happened when markets are going up. As long as you have long holdings in that portfolio as well, they're rising in price as the markets are going up, then clients can have a positive economic value while they're also generating tax benefits.
That's the tax loss harvesting. Absolutely. And so, Cliff, kind of going back to something we addressed earlier in the call, some investments are tax efficient and you should put them in taxable accounts. And can you talk about that? So Dylan was asking, did you say that corporate bonds are generally best to hold in pre-tax accounts and that equities and ETFs are better suited for after-tax accounts?
Yeah, it's a great question. And it really, we think about it more at the asset class level rather than the product level. So things that generate ordinary income or assets that generate ordinary income, things like corporate taxable bonds, private credit is another one that the returns that get generated primarily come in the form of income. Those typically are going to be better positioned in something like an IRA or a 401k, something that's a pre-tax account, because as we know, within an IRA wrapper, for example, you don't pay taxes on any of the earnings that the portfolio generates over time. You only pay taxes on the back end when you make a withdrawal. If you were to hold something like a corporate bond in an after-tax account, however, you're going to pay, typically you're going to pay ordinary income rates on the income. And if you're in a high tax bracket, especially at a high tax state or high municipality, in some cases, we have clients that their marginal tax rate is north of 50%. So your every dollar in income that you get, you're turning around and having to pay half of it to the government, and that's just not a great way to invest if you can help it. Equities that you buy and hold for the long term are generally tax efficient because you only you pay dividend rate, which is going to be lower than ordinary income. You pay on sales, but you don't pay on growth. Same thing for real estate. A lot of times real estate is going to be much more tax efficient. So you would want to hold that in an after-tax account compared to something like private credit, where you're generating very high levels of income. You want to protect that and put that in an IRA.
Absolutely. Yep. So that asset positioning is very important. And that's a big blind spot, I think, for a lot of people. Lots of questions on OZs. Let me just go through those quickly. Does the character change short-term or long-term during the deferral period? It does not. If you defer a short-term capital gain, it will be a short-term capital gain. If you defer a long-term, it will be a long-term when you realize it. And there was another one on here. Can I use an OZ to offset my capital gain from the sale of a primary residence? You can and you can't. A primary residence has a 121 exemption, so you have a $500,000 exemption for a married couple on a primary residence. Anything over and above that, that's just a capital gain. You can put that into a qualified opportunity zone fund. Glenn, I think I would go back to you on this. Like maybe you hear this from time to time. I'd be happy to hear you clean this up. But listen, Dean is asking us, like, I understand the concept of tax loss harvesting completely, but I don't understand the concept of intentionally losing money on an investment simply to avoid paying taxes. This seems futile. Can you explain?
Of course, yeah. So this is a tricky one, but think of if you invest in the Russell 1000. If you look at the return of the broad index, it can be up. But if you look at the 1,000 companies underlying that index, you're going to have some that have made money for the year and plenty that have lost money for the year. So as long as more companies in that index made money than lost money, the index is going to show a positive return. But that cross-sectional volatility gives opportunities for generating tax benefits. So think of if I just bought 200 stock, or say I just bought 100 stocks, so I started $100, 55 of those stocks are up $1, 45 of those stocks are down $1. Well, my investment made money, right? I made $10 of market appreciation there because $10 more was up than down. But the 45 that were down, I can use those to generate capital losses or tax benefits. And then as long as I replace them with a similar stock, not the identical stock, I haven't violated any wash sale rules. So I would say tax loss harvesting is using breadth, using a lot of diversification to the strategy's advantage. You wouldn't want to do it across 3 stocks. There's a huge advantage of doing it at a couple hundred. And I want to be clear too, at Quantinno, we would expect anything we do tax loss harvesting wise to add an investment return pre-tax. So if you have a long short portfolio with us, our expectation is over the long term, that would add to the investment return of the account while it's generating tax benefits. We aren't going to ask clients to lose economic value while they're generating tax benefits at Quantinno. There's going to be some investment outperformance and underperformance at times. Every manager has that. But on average, I would expect clients to make investment returns while they're generating tax benefits with Quantinno.
Exactly. Yeah, I think that's a good summary. So it's a little bit complex. We're taking a loss on paper so that we can carry that loss forward and offset future tax liabilities. But your account will be, theoretically going up in value. That's the concept. We essentially are at time. I have all of these questions. There's a lot more questions coming in. I appreciate everybody staying on till the end and getting these questions in. A lot of them are very similar. So I will send these out to Glenn and Cliff, and we'll just email you. We'll email you the answers to all these questions because there's quite a bit coming in. This was quite an interesting topic, it seems like, but we are at the hour, and I want to make sure we're respectful of everybody's time here. So thanks very much to Glenn for joining us. Thank you so much to Cliff for joining us. Your insights were invaluable. This is really complex stuff, and I think you whittled it down pretty simply, and I think a lot of our investors got some benefit out of it. Our names and email addresses are all right there. You can feel free to send us an email with any questions that you have. If you did submit something through the Q&A, we have those questions already, so we will get back to you with answers if we didn't finish them live. So thank you both for joining us. Thank you everybody for attending, and we will catch you on the next Origin Advisor Series. Thank you.
Thanks everyone.
Thanks all.